Thank you very much for inviting me to this very interesting conference. I learned a lot in these 2 days, and actually one of the striking things I learned is that we have a lot more data than we have, say, 5 or 10 years ago, or very granular data, and we are very much better able to pinpoint specific risks than we used to be. And of course, that's very important if you want to activate macroprudential instruments. I want to discuss 3 things. I will first go into recent developments in the Netherlands. As you may know, we had some significant correction in our housing market, but also in our real estate market. We are recovering now, but we still have vulnerabilities, especially high household debts. I will discuss that. I will also discuss risks we see, risks that manifested themselves in the crisis, but also underlying risks. And I will end, at the end, I will go into some policy options. Well, first of all, developments in the Netherlands, in commercial and residential real estate. By the way, most of my presentation will be on the residential real estate. Well, after some difficult years, both residential and commercial real estate markets are clearly recovering. The housing market is picking up across the board in the Netherlands, and as we have seen in many other cases during this conference, there's a regional difference in which the large cities, including Amsterdam, which is included here in the graph, are recovering much faster, and actually house prices in Amsterdam are now significantly above their peak level of 2008. For the country as a whole, this peak level has not been reached yet, but it's clearly recovering. Actually, DNB published a report specifically on developments in the large cities on the housing markets a few days ago. So if you're interested, you can look it up on our website. One of the conclusions of this study is that actually there are some signs of overheating in cities like Amsterdam. At the same time, we see that the booming housing market is not really credit-driven. So it's a bit nuanced picture in terms of risks. If you look at the right-hand graph, commercial real estate, the divergence is maybe even more extreme than in the housing market. This is not between Amsterdam and the rest of the country. This is for prime locations versus the rest of the country, and especially these prime locations, prices have increased a lot. The rest of the country, it's not. The market has stabilized, but it's not really picking up yet. We have to see how this will develop in the next years. Well, take a step back now, the past decades. This is one of our main also vulnerabilities I will come back to later. Mortgage credit has expanded quite significantly over the past decades and actually accelerated in the 1990s, in the run-up to the crisis. So this is a striking development, several reasons for that. It's also a vulnerability that won't quickly disappear in the next couple of years. So, and I think one of the key aspects of the ESRB recommendations also for the Netherlands is to have a closer look at these debt levels and take measures to reduce these debt levels. It's not just grown, it's also high in international perspective. I think we are about the same level as Denmark and a bit lower than Switzerland. This is debt in terms of GDP, total household debt, which is around is more than 120%, most of which, of course, are mortgages. Another striking comparison is the right-hand graph, where the debt ratios is plotted against LTV for home buyers, and there also the Netherlands, but also Switzerland is one of the highest levels internationally. This is clearly correlated. Of course, this is important because high LTVs for home buyers means if there is a correction, then a significant amount of them will be will have negative home equity. Well, what is the cause of all these these high debt levels? Now, the number one reason is the tax system. Interest rates have been fully tax deductible in the past decades. Also, home ownership has increased. That has been promoted by the government. The Bundesbank also mentioned this. In Germany, the government is planning to do that. Well, I would be very careful to do this, because if you do this without macroprudential instruments, you will get something like this. So that is quite significant. And our home ownership went, I think, from about 40% in the early 90s to 60% at this moment. It's not increasing anymore. And of course, if home ownership increases, it means new starters are entering the market, and they typically have to borrow a lot. So this is an extra reason. A third reason is supply restrictions. This is something we have to live with in the Netherlands. We're a small country with many people, many zoning restrictions. So I think, yeah, we can try to relax that a little bit, but I think it will also always be an item for the Netherlands. Especially in cities like Amsterdam, where home ownership is lower than the national average, so there's a lot of excess demand for housing. And fourth reason is not often mentioned, but I think also very relevant. We have a quite well-developed second pillar pension system, so almost all employees are participating in the system. It's compulsory for almost all employees. So whereas in other countries, people typically pay down their mortgage debt over their lifetime to have some extra equity which they can use after retirement, there's less of an incentive to do that in the Netherlands. And international comparisons show that this is typically also the case in other countries with high household debt. I believe also in Denmark or the UK, US. So this is also an important reason. Well, turning now to the risks, has been mentioned already a couple of times. One of the key risks we see is that high indebtedness and lax lending standards tend to exacerbate the financial cycle. So this graph on the horizontal axis, you see the increase in debt ratios between the end of the 90s and 2007. And on the vertical axis, you see for two groups of countries, you see the increase in house prices. The light blue dots are house price changes in the run-up to the crisis, up to 2007. So it's higher debt levels went hand in hand with increasing house prices. And the opposite you see in the period after the crisis. So there, the same countries tended to have lower or even on average decreasing house prices. So I think there are several. So the ECB presentation yesterday also pointed to this point, and Casper also for Sweden showed that this is really a lot of credit-driven activity here. So this is one broad risk. A second risk, which is very significant for the Netherlands, because we have such high LTVs for home buyers, is that if prices decline, there is a very large proportion of homeowners with negative equity. So this is the number of underwater mortgages split into three groups. So especially the young homeowners below 40, so it's quite a big group. The vast majority, around 75%, has been underwater at the peak of the crisis. And this is very important because these are all, as we know, also the households which tend to have high propensities to consume. This is really a very pro-cyclical, powerful pro-cyclical phenomenon. Another risk, bank funding risk, also I think mentioned for Sweden already, but it's also what we see in the Netherlands, it's difficult to really have a kind of causal relationship to prove what the causal relationship is, but it is striking that in the 90s, when household debt went up so fast, that was exactly the same years, and you see here both patterns, which are very equal, that loan-to-deposit ratio also went up. So banks really, they tapped financial markets, increased their wholesale funding, which was necessary to fund these mortgages. And of course, as we know, in the crisis, this turned out to be a vulnerability. Well, finally, so risks, they pop up in several places, but one place they did not. So that is credit losses. Credit losses, very striking, remained very low. So that's the light blue line. So despite this strong correction, many underwater mortgages, people continued to pay their mortgage, as we have seen in the UK earlier today. This is very striking. I don't know to what extent this is typical for the Netherlands or the UK, or you would also see this in other countries. One of the reasons may be that creditors are in very strong positions. If you don't repay your mortgage, they can put you out of your house, so to speak, in a few months, so that you have a very strong incentive to, whatever happens, to continue to pay your mortgage. So that's important also to keep in mind. Now turning to policy options, I summarized a number of them in this table. I presented a bit of a kind of 3 lines of defense. You can try to lean against a cycle, increase your resilience, and not much discussed actually in this conference, but you also can, if there is a crisis, you can try to have some safety nets, and some countries have implemented that to support households to continue paying their mortgages. And these are the macroprudential policy measures you can take. Yeah, we have implemented several of them, even though we haven't had a booming housing market in the past years. We have tried we learned from the crisis, and one of the measures we have taken is to implement an LTV limit. Although this is not at a very high level, we started at 106%. We didn't have any limit in the past, but 106% we started. It's gradually declining 1% a year, and next year it will be 100%. And the government may even decide to go further than that, but they haven't decided on that yet. Internationally, this is of course still very high, and there have been several recommendations by the IMF, I think the ESRB, but also DNB and our Financial Stability Committee to go further than this 100, to reduce the LTV limits further to 90%. Secondly, there was an LTI limit, or more like a debt service to income limit, to be more precise, which has been tightened somewhat. Third, we increased our monitoring, the intensity of our monitoring of these risks. Well, you could argue this is not a tool, but we think it's very important to get more grip on the underlying risks. So we started to use much more data, micro data, loan level data. We have, since 2 years, also more legal powers to collect data, especially for macroprudential or financial stability purposes. So we can actually go to not only banks, but also non-financial institutions, the land registry, for example, and collect much more data on for instance, housing market. One example is that banks are reporting every year now the commercial real estate exposures to us. And maybe in the future this will lead to policy proposals. And last but not least, the government has addressed the issue of tax benefits. So interest rates used to be fully tax deductible. It's now, these benefits are gradually reduced. Actually, very gradually. I think it takes about 20 years to go from the marginal tax rates to a lower tax rates. It's still... And actually, DNB has advised to accelerate this. Of course, we also think you should do this very gradually, but because interest rates are so low now, this is a very good opportunity, because low interest rates are making this easier. With low interest rates, the tax benefit is less, so it is less painful to accelerate this right now. So there's interest deductibility, but also other measures has been taken. Stamp duty has been reduced, and also, which makes it easier, of course, to have lower LTVs. And there is some requirements that for new mortgages it has to be at least an annuity scheme. So we used to have interest-only mortgage, most of the people, and now you have to repay according to an annuity scheme or a linear scheme, which of course also helps to reduce the increase in debt levels. Okay, this was all I wanted to say. Thank you very much.